I've been looking at Smartcentres and RioCan because with the Canadian economy starting to reopen, with the broader market starting to recover, surprisingly, it got me thinking, are these REITs worth owning? Especially in an environment where H&R REIT, being big real estate investing company, has just recently cut its dividend by 50%, with Laurentian Bank also cutting its dividends and a bunch more. So if you are an income investor, you're probably thinking, is this dividend safe? I'm wondering the same too, because I actually own RioCan. If you're a value investor, you're looking probably for undervalued stocks, and I want to investigate, is it a good time to buy? In today's video, I'm going to share the short-term outlook for those two companies, being 3 to 6 months. I'm also going to share my medium-term outlook and look at, in comparison to a worst-case scenario, basically kind of comparing back to its previous history during the financial crisis and how did it actually behave, and that would give us a glimpse of what it could do during a worst-case scenario. I'll also look at if those two stocks deserve to be on your buy list, so that you can make an informed decision of whether or not to buy these two REITs. Hello everyone, welcome to Financial Nirvana Mama, where you learn to invest your money like a pro because it's mission critical to your success. I want to send a shout out to all the subscriber community. Thank you from the bottom of my heart. I also want to say, hey, if you're new to this channel, be sure to hit that subscribe button and that bell notification so you get the latest and greatest videos coming to you. And for those of you, hey, if you found this video helpful, be sure to smash that like button because it really, really helps with the algorithm and sending this video out to more and more people like you who it could really help with their investing journey. So let's get back with the video. Particular interested in these two REITs right now is because of value and opportunity. These shares are actually priced as though no one's going to be shopping ever again. So a word of caution though, in the grand scheme of companies to buy, there are so many more better ones. Right now, these two companies are fairly high risk, and the only reason why I'm discussing them is because I actually own RioCan shares in my portfolio, and I really wanted to share my outlook for RioCan in comparison to Smartcentres. I'm looking for in REITs right now is number one is value, and number two is opportunity. If you are someone that is looking for income, because this 9% yield, meaning the 9% return on your investment, that's dropping you money every single month, is very, very, very attractive. But if you actually rely on the income to pay your bills, to pay your rent, I would really, really caution against buying these two REITs. I wish we had a magic crystal ball that could tell us the future, but we don't. There is more risks than rewards if you're looking solely for income. But if you are a value investor, then there might be some opportunity for you, because I've actually taken the time, looked at its transcripts, its recent financial statements, and as well as its investor presentation, which is saving you a ton of time. So let's dive in now on the highlights. RioCan has amazing tenant profile. It's got a lot of essential services, as well as it's got a diversified portfolio where every one of its companies that it has on its portfolio makes up no more than 5% of its entire revenue, which is really good, which means it's very, very diversified. With the Smartcentres, they've also got a lot of essential services companies that are still operating right now, being Shoppers Drug Mart. We've also know that its anchor tenant is Walmart, which takes up 25% of its revenue, which is amazing, which means that it is getting a lot of reoccurring revenue. But of course, we're going to be focusing on how much rent is it collecting. When we look at the stats, they're saying that 72% of their expected April rent was collected, with May being following a similar trend, which I really liked. The fact that they pointed out that May should be very similar to April. Both companies have had rents that need to be deferred, and both businesses have small businesses being retail shops where they're probably going to have a bit of problems collecting rents. With both companies, you can see that a portion of the rent that they're collecting is from small businesses. And thankfully, there is a lot of subsidies coming out right now with government relief, which is helping these small businesses where a portion of their loans, which can be unsecured, it could be forgivable. Let's look at RioCan's payout ratio, which is focusing on the funds from its operations, which is really its income that's collecting after doing all the accounting gymnastics. Can it afford to pay you its dividends? And you can see with RioCan, it's 77.4%, which is really good because we want to look for a payout ratio that's less than 80% with any dividend investing company. Let's look at Smartcentre. Personally, I was a little pissed off that I had to scroll all the way to the bottom of the presentation to actually get Smartcentre's payout ratio, which I find a little bit sketchy. And I could see now why, because you could see that in 2019, it had already a really high payout ratio of 87.5%. A little bit higher than RioCan, which is kind of a bad sign because it also hasn't shown its FFO payout ratio for Q1. And that is kind of giving me some alarm bells as to why it's not sharing. Finally found it, I went into their financial quarterly report. Their payout ratio is 83.3% as of end of March 2020. 83 compared to 77. I would be very cautious now looking at Smartcentres in comparison to RioCan. Then we could definitely see its payout ratio probably increasing quite a bit over the next quarter. Let's look at its financial position, being able to survive for the next quarter and the next 2 quarters, and be able to, of course, pay out the dividend to you. I found that if the rental income did decline by about 5%, its payout ratio can easily increase to 100%. In other words, RioCan's cash flow may not have enough funds from its operations to pay out its dividends for at least several months, if not longer. But on the bright side, RioCan has a lot of liquidity, I think up to $1 billion. It has a lot of available borrowing capacity under its credit facilities. Until the rent collections improve and the small businesses get actually access to this rent relief program, which I don't know how fast it would be, RioCan still has the liquidity to cover any cash flow deficit for the dividend. Look at Smartcentre. They are also in the same position. Their rental income just decreases by a little bit. They might not even have the money to cover its dividends for this next several months. Same position as RioCan. So let's look at Smartcentre's liquidity. So they have a $500 million liquidity, but their dividends cost about $190, $200 million annually. It does have enough liquidity to cover its cash flow deficit for the dividend. During the 2008 financial crisis, both companies continued to pay out their dividends, which is amazing, which is a huge plus. The only thing about Smartcentre is that they did put a pause on the growth of their dividends, which is still okay because they still paid out their dividends. Let's look at the CEO of RioCan. He just had a recent video, which it was posted on Bloomberg, and said, the company is in its strongest financial position. He is very confident that the company is going to continue to pay dividends, which is double check marks from my perspective for RioCan. On the positive side for Smartcentres, the CEO owns about more than 10% of the company. So I would say he's got a lot of skin in the game to having this company survive and do okay. So I would imagine that also he's going to probably place some emphasis on the dividend, but he did not say anything in any of the transcripts or the presentation about the dividend, which gives me a bit of sketchy spidey senses. With both companies, let's look at the long-term outlook, say 2 to 5 years right now. With the low interest rates, because in the environment we're in, we're going to have low interest rates for quite a while. Both of those companies' real estate values are going to do very well because typically real estate values increase with low interest rates and with inflation. Also, they're going to probably be able to drive some of the rents up over time because they have a really good, strong tenant base, and they're going to be able to drive their asset values. Despite both companies not having, say in the worst case scenario, if both companies had no needed access to more funds, because their asset values is worth so much, they can actually put mortgages against their real estate and unlock some more funds. With RioCan, they said that they have $9.3 billion of unencumbered assets. So essentially, they have a lot of money that's still locked up in these properties that they can get access to. And I think Smartcentre is in the same position. Maybe not as much, but they can definitely get access to some of their value in their real estate. So you can see that in the future, both companies can definitely do well in the medium term from 2 to 5 years, as long as it's able to find a way to survive in the very short term. Personally, I actually like a RioCan because RioCan is actually doing this big development project just down the street from my house. I really was looking to invest in another house in this area because it's nearby distance to transit, and it's the schools nearby. It's got a lot of potential for it. So the fact that they're doing the same thing and doing this development project very close to where I want to invest in and in the area that I live in just sends me like double positive signs. But at the same time, Smartcentres, they have a very good business model where their anchor client is Walmart. And back in my construction engineering days, I actually worked for a Smartcentre construction project for 4 years of my life. And I could see how when they turn around in a certain area, putting a Walmart and building businesses around it, they can also grow this residential neighborhood. And it really turned around this neighborhood that I thought had no potential to so much more potential. So I would say just be cautious if you're looking to invest in either of these REITs. Looking back at the REITs from a chart perspective, you can see that both REITs have definitely lost a lot of value, and it's at its ultimate lows, very close to its 2008 low. So I would say that's severely undervalued, like as if no one's going to actually go shopping. So there's definitely a lot of value if you're looking for value stock. Just being cautious for those who are relying on its income. I would say both REITs are of definitely a higher risk. I hope you found this video super helpful. If so, give me a thumbs up, and be sure, if you haven't subscribed, be sure to hit the subscribe button and you'll get the latest and greatest videos coming to you.